And that's the part nobody on financial TV is willing to say out loud. Silver is down 40% from its January peak. It just dropped 3% in a single trading session. Fortune is publishing depressing daily price updates. Reddit is screaming that silver is dead. And while everyone is panic staring at red candles, the actual silver market, the physical one, where ounces get mined and bought and consumed, is heading into its sixth consecutive year of structural deficit. The price chart and the supply chart are pointing in opposite directions. That has happened exactly twice in the last 50 years, and both times the people who bought during the disconnect made generational money. Quick heads up before we get into the numbers. I'm AI Ryan Matta. The real Ryan is heads down on a much bigger build for the channel right now, so I'm handling delivery, but every word of this script was written by him, and the analysis is his read on the silver market as of Wednesday, April 29th, 2026. Today is also FOMC day, and Powell delivers his rate decision in a few hours, so by the time you finish this video, you'll know exactly what to watch, what's already priced in, and why the bigger story for silver has almost nothing to do with whether the Fed holds or cuts. Let's get into it. So here's where we actually are. As of yesterday's close, Tuesday, April 28th, silver settled at $73.46 an ounce. That's a $1.82 drop from the day before, roughly a 3% move in a single session. The selling has been brutal, and it has been fast. Just 3 months ago, on January 29th, silver printed an all-time high of 121.64 per ounce. From that high to where we sit right now, we are talking about a 40% drawdown in roughly 90 days. That is one of the fastest precious metal corrections in modern history. But here's the part the headlines are not telling you. At $73.46, silver is still up over 122% compared to this time last year. Anyone who bought silver in October of 2025 or earlier is sitting on a serious gain. The crash narrative you're seeing on social media is the story of people who chased the top in late January. It is not the story of the asset. So why did silver fall so hard, so fast? Three forces converged at once. The first was technical. When silver punched through $100 an ounce in late January, the CME Group, which runs the largest commodity futures exchange in the world, sharply raised margin requirements on silver futures contracts. Higher margins mean leveraged traders have to put up more collateral. A lot of them couldn't or wouldn't, so they sold. And once the selling started, the cascade fed itself. Stops got hit, more margin calls went out, more selling, classic forced liquidation. The second force was the dollar. On February 28th, the Strait of Hormuz was effectively closed as the US-Iran conflict escalated. Crude oil surged through $100 a barrel. That fed straight into inflation expectations. CPI is now sitting at 3.3%. The Fed reacted by signaling no rate cuts in 2026. The dollar index responded by ripping higher. And here's the math that matters. Silver is priced globally in dollars. When the dollar gets stronger, silver becomes more expensive for buyers in euros, in yuan, in rupees, in yen. Global demand softens. The price falls in dollar terms even when the underlying physical market is tightening. The third force was simple profit taking. Silver had run 147% in 2025. After a move like that, a 30 to 50% correction is not a crash. It is normal. It happened in 1980. It happened in 2011. It happened in 2020. Every major silver bull market in history has had a violent mid-cycle drawdown before the second leg higher. Now let's talk about today because it matters. The FOMC decision drops at 2 p.m. Eastern. CME FedWatch is currently pricing a 99.5% probability that the Fed holds at 3.50 to 3.75%. So the rate decision itself is essentially a non-event. The market is not trading the decision, it's trading the dot plot, the press conference, and any hint about what comes next. If even one Fed governor moves their dot toward a cut, silver pops. If Powell sounds dovish about inflation peaking, the dollar falls and silver runs. If he doubles down on hawkish, silver likely breaks $70 and tests $65. The technical map for the bears is clear. A daily close below $73.50 opens the door to $69.50, then $65.30, then the $61.30 low. The bull case needs silver back above $75.60 to flip the short-term bias. So watch Treasury yields and the dollar index right after 2 p.m. That tape will tell you everything you need to know about the next few weeks. Now here is where it gets interesting because the FOMC is the short-term story. The medium-term story is the deficit. And the deficit is what almost nobody in mainstream finance is paying attention to. The Silver Institute, the most authoritative body in the silver market, projects that 2026 will be the sixth consecutive year of structural supply deficit. Their forecast 67 million ounces of shortfall in 2026 alone. Bloomberg's analysis from Metals Focus puts it at 46.3 million ounces. Either way, demand is outstripping supply, and it has been for half a decade. From 2021 through 2025, the cumulative deficit drew roughly 900 million ounces out of above-ground inventories. That is a number worth pausing on. 900 million ounces. That is the equivalent of more than an entire year of global mine production gone, consumed, deleted from available supply. And here is why that matters. Mine production is forecast to grow about 1% in 2026 to roughly 820 million ounces. That is the highest level in a decade, and it is not enough. Demand keeps outpacing supply because silver supply is structurally constrained in a way most commodities are not. Roughly 70 to 80% of the world's silver comes out of the ground as a byproduct of copper, zinc, and lead mining. Dedicated silver mines are rare, so when silver prices spike, you cannot just turn on more silver mines. The supply response is tied to copper and zinc economics, not silver economics. And even when the market wants new silver mines, it takes 7 to 15 years to go from discovery to meaningful production. Mining is not software. You can't scale it on demand. That brings us to the demand side, and this is where the story gets explosive. Industrial demand now accounts for over 55% of total silver consumption, and it has grown 50% since 2015. Why? Because silver is the best electrical conductor we have ever found. Better than copper, better than gold. And the modern economy is in the middle of an electrification supercycle. Solar panels alone consume roughly 120 to 130 million ounces of silver every year. Global solar capacity is expected to hit 665 gigawatts by 2026. Yes, manufacturers are working hard to reduce silver per panel. That's called thrifting. But global installations are growing fast enough that total silver demand from solar keeps rising. Electric vehicles are the next big channel. The average EV uses about 5 grams of silver, sometimes more. With 14 to 15 million EVs forecast to roll off production lines in 2026, that's 70 to 75 million ounces of silver demand from EVs alone. That single number is larger than the entire 2026 projected market deficit. Then there is AI. Every data center being built right now to host the next wave of artificial intelligence requires silver in busbars and connectors in the conductive paths of the silicon itself. The Silver Institute is now flagging AI infrastructure as a structural new demand driver. We are talking about hundreds of billions of dollars of capital expenditure, and a non-trivial fraction of that ends up consuming silver. Here's the killer. Industrial silver is consumed, not recycled, not at any meaningful rate. When silver goes into a solar panel, it sits on a roof for 25 years before that panel gets retired. When it goes into an EV, it stays in that car for the life of the vehicle. When it goes into an AI server, it gets cycled into the long tail of e-waste that almost never gets reprocessed for silver. Every industrial application is a permanent withdrawal from above ground supply. And then there is China. On January 1st of this year, China implemented a brand new export licensing regime for silver. Only 44 Chinese companies are now authorized to export, and they have to meet minimum production and credit requirements to qualify. According to Peel Hunt, that single policy could affect 60 to 70% of refined silver supplies because so much of China's silver output is a byproduct of its copper and zinc processing. China has officially classified silver as a strategic material. Translation, they are keeping it. They are not selling it onto the world market the way they used to. And as of early 2026, China's silver imports hit their highest level in 8 years. They're not just keeping their domestic production, they're buying everyone else's too. So you have a market with shrinking deliverable supply, an industrial demand profile that does not care about price, the world's largest industrial consumer actively hoarding the metal, and 6 straight years of structural deficit drawing down above ground inventories. And the price just fell 40%. That is the disconnect. That is what the major banks see. Let me give you their numbers because the institutional outlook on silver is dramatically different from the retail panic. Reuters projects an average silver price of $79.50 for 2026, already above where we sit right now. JP Morgan Global Research is at $81 for the 2026 average, with the physical deficit projected to reach 245 million ounces. Bank of America has a target range of $135 to $309. Citigroup is sitting at $150 to $170. Macro strategist David Hunter is at $180. And inflation-adjusted long-term targets, depending on methodology, sit between $150 and $250 an ounce. Even the most conservative published target, Reuters at 79 to 50, implies upside from where we are today. The aggressive targets imply silver is in the early innings of a multi-year revaluation. Now let me connect this to the bigger picture because this channel is fundamentally about Bitcoin. Why am I spending 20 minutes on silver? Because silver and Bitcoin are siblings. They are both responses to the same problem, a fiat monetary system where the money supply goes up forever, where central banks are politically incapable of running tight policy for long, and where every major debt crisis ends the same way, in debasement. Bitcoin is the digital answer. Silver is one of the analog answers. They are both bets that the dollar's purchasing power is going one direction over the next decade. But each one has something the other does not. Silver has an industrial demand floor. Solar, EVs, AI, those use cases consume silver no matter what Powell says or what the dollar does. Industrial demand is not discretionary. Bitcoin doesn't have that floor. Bitcoin has something better, absolute scarcity, programmatically guaranteed, with a hard 21 million cap that no central banker, no government, no miner can ever override. They are different tools for different parts of the same thesis. The smart play is not picking one, it's understanding both. The Fed will eventually cut. Inflation is sticky, debt service is exploding, and the political pressure on the central bank is only going one way. When the Fed eventually cuts, the dollar weakens. When the dollar weakens, silver runs. The gold to silver ratio currently sits around 50 to 1, near its historical average of 60, but every major silver bull market has compressed that ratio to 30, sometimes to 15. If silver just normalizes to a 30 ratio, while gold sits anywhere near $4,500, you are looking at silver near $150 per ounce. That is not a moonshot scenario. That is a mean reversion scenario. So what's the actual call here? I'm not going to tell you to back up the truck on silver tomorrow. I'm not your financial advisor. What I am telling you is that the silver story being shouted in headlines and the silver story being whispered by JP Morgan and Bank of America are two completely different stories. The chart is bearish. The fundamentals are violently bullish. That tension always resolves. It just takes longer than people think. Watch the FOMC at 2 p.m. Eastern today. Watch the dollar. Watch what Powell says about inflation. And ask yourself which side of this disconnect you want to be standing on 12 months from now. If this kind of analysis is useful to you, hit subscribe so the algorithm keeps feeding you more of it. And if you want to know exactly how much Bitcoin you need to retire on your own terms, based on your age, your income, and where Bitcoin is actually heading from here, head over to bitcoinmaxing.com. The Bitcoin retirement calculator is completely free, takes about 3 minutes, and gives you a real number instead of vibes. Links in the description below. I'll catch you on the next one.